My name is Chaurushiya. I'm the Chief Intellectual Property Officer at UCLA TDG. It is my pleasure to introduce the panel's moderator, Josh Green. Josh has over 4 decades of experience as a lawyer, venture capitalist, and entrepreneur. He served as chairman of the National Venture Capital Association and has been a member of more than a dozen boards of directors of venture-backed high technology startups. He has led IPO process for over 100 companies and completed over 1,000 venture financing and advised over 300 venture-backed startups. Josh, I'll turn it over to you to introduce the panelists.
Thank you. Thanks very much. And, it's a pleasure to be here. I'm actually, my most proud accomplishment is that I'm a double Bruin. I'm undergrad and law school here at UCLA. So I'm not going to continue to introduce myself, but rather ask Mira to introduce herself, each one of our panelists to introduce themselves briefly.
Hi, Mira Chaurushiya. I'm a managing director at Westlake Village Biopartners, which is an early stage biotech-focused venture capital fund located here in Westlake Village, just northwest of where we are right now. Been here for a couple of years, but prior to Westlake was at another early stage firm called 5AM, and then my background prior to venture is entirely on the research side. So 15 years all over the country, academic and industry research. Was at Genentech for about 4 years before moving over to the venture side. So thanks for having us here today.
Hi, I'm Sahil Chopra. I'm a principal at Vertex Ventures HC. By the way, not affiliated with the pharmaceutical company Vertex. I know a few people reached out to me and they were like, hey, Vertex Pharmaceuticals. I was like, no, never were involved with Vertex, never will be. Yeah, we invest in early stage biotech companies. Series A, Bs usually are sweet spot to invest in. I would say we also do medtech. I know Orange County is huge in medtech, so we do medtech as well. And yeah, very nice to be here.
Good afternoon, everyone. I'm Jakob Dupont. I'm an executive partner at Sofinnova Investments. We tend to invest in private companies pretty close to the clinic within 6 months of an IND, phase 1, phase 2 as well. Private companies, about 80% of our investments. We do some company formation as well. And I'm a physician scientist by training and a medical oncologist with academic career at Sloan Kettering and Stanford here in California. And then also a 17-year industry career at Genentech Roche for about half the time. And then 3 small biotech companies as chief medical officer at Oncomed and Gossamer Bio and head of R&D for Atara Biotherapeutics just up in Thousand Oaks, not too far from here. And nice to see you all.
Good afternoon. My name is Stacy Feld, and I'm regional head of Johnson & Johnson Innovation. I'll tell you a little bit more about Johnson & Johnson Innovation in a moment. I feel the need after that illustrious introduction of my panelists to share a little bit about myself. I don't often admit this, but I'm a recovering lawyer, and after that great introduction of Josh and his, still in recovery. After that great introduction of Josh and his contributions to our industry, I'll just share a little bit. So 27 years in healthcare, intellectual property licensing at Wilson Sonsini, business development, including 5 years at Genentech, like so many of the panelists here, and venture investing at the intersection of life science and consumer health, and then for the last 10 years at Johnson & Johnson. So Johnson & Johnson Innovation is focused on unlocking breakthrough science and technology to solve the most toughest healthcare challenges. And we do this by forming global teams in 4 innovation-rich areas. I lead West North America, and thus we're here this week at LA Best and spent yesterday meeting with a number of the fantastic research institutions and academic centers here. And we engage with the innovators to bring in the most promising science and technology that exists outside of Johnson & Johnson. And we partner with innovators by incubating early stage companies, partnering with companies early and late, and of course, making strategic investments in companies. And my comments throughout our discussion will reflect that broader investment, lowercase I, approach that we take to accelerating companies and entrepreneurs.
Great. Well, you can see we have quite an illustrious panel. And for those of you who were here for the last panel, I want to call that, I'm going to rename it the funded panel, okay? Where this panel is about the unfunded, okay, and those wanting to be funded. And so my first question to our panel is, I'm not going to use the term Mira used, which is nuclear winter, which sounds quite ominous, but rather we're in a deep freeze in funding. No one can deny that. But we also start to see signs of a thaw. And I'd like for each of our panelists to address what they're seeing out there on the landscape of venture capital generally, and then how their firm in particular is approaching it.
So I think there's sort of two ways to look at this. One, what's happening at the earliest stages, company formation, Series A's, those early stage rounds, and then what's happening at the later stages. We are early stage investors, company formation, seeds, Series A's is where we specialize. And I would say, and remind everyone that there is still a lot of capital sitting in the early stage ecosystem that's ready to be deployed. So it's not like the capital is not there. I think what has changed, though, is the bar to get that capital. And that environment has become a lot more conservative. And so what that means is if you're out there looking for the seeds and the Series A's, you're not going to do as well around a platform that doesn't have a defined product or without, a team that's done it before, especially if you're looking for the large Series A's and those kinds of financings. In the past, early stage investors were willing to take a little more risk on both of those fronts. But right now, the stories that get funded are around products that are close to the clinic, where the early stage capital can fund those first sets of clinical data. And so there's just that sort of tightness in the early stage market that I think is what's difficult to navigate. It's not that the capital isn't there. On the flip side, and we see this, of course, as our companies move to Series B, the capital is tighter, and by then you really need to be a clinical stage company. I think the haves and have-nots are the companies that get through Series A but don't quite get to the clinic. We're seeing, the companies that are of that profile really, really struggle.
I think the rock bottom is behind us. Definitely, I do think so. I would say that we were definitely seeing signs of thawing happening. Especially, I think it started during JP Morgan when a bunch of deals have been announced. There've been a few acquisitions that have happened in the last 2 months. It bodes well for the biotech markets, I would say. Especially if you're in these hot areas like radiopharma or ADCs or cardiometabolic, obesity. It's the right time for people in those areas to actually raise money. We as a fund have we've identified some areas that we feel are going to be the ones that we're going to invest in the next 2-3 years, and are constantly looking for those companies. And I would say that it's the LA area. I would say have shown really great companies, and they've come down. And we've invested into one of those LA companies, Toll Biotherapeutics. And I would say that some of the talent that we're seeing from here has been great in terms of just the kind of thawness that we're seeing, as you were saying. It's going to be a game of haves and have-nots. People who have money, they're going to raise 150 million rounds. People who don't have money, they'll struggle to raise 20 million in capital. And it's just about how you can really differentiate yourself from a lot of companies that are out there And there is a lot of capital that, as Mira was saying, which is available out there. It's just that how you can navigate that capital and be in front of the right people at the right time with the right story. So yeah, I would say that it's definitely getting better.
So I would agree with a lot of what's been said. I do think that there's definitely money on the sidelines for companies to receive. We've seen to this point, there's been some really nice merger and acquisition activity over the last 6 months or so. We've also seen some sputterings and some IPOs going out of late, which is nice to see. Even a couple of companies here, Rapport and Telex, with S1s on file, and I think it's encouraging to see that. So I think there's opportunity, but I also think the statement that we're in a pretty risk-averse time is absolutely accurate. And so when investors look at opportunities for investment, at this point in time, we really want to focus on de-risk opportunities. And I think so. As a founder or company, CEO, as a company, as you're going out, you're trying to get funding, you have to think about who are you speaking to. Is it the appropriate investor where they have that focus of investment? If you are an early clinical company, are you speaking to those VCs that are investing in early clinical? That's just important. If you've got a certain therapeutic focus, do you know that there are certain funds that are going to be more interested in obesity or in oncology and maybe less interested in IO or what have you? And I think Sahil also made the right point about there tends to be hot areas. I think that's another reality, and cold areas, so to speak. So I think it's sort of reading the pulse of the environment where there are certain areas, whether it's ADCs, whether it's radioligand therapeutics, whether it's obesity opportunities, whether it's I&I, and those are all pretty hot areas. Then some other areas are going to be more controversial, cell therapy. Some people like investing in that, others don't. And then IO, as I mentioned, it's a tough time for IO as well. So I think it is about understanding your investor. It's about understanding the current environment. And then I also think because we're pretty risk averse at the present time, the more rigor around the plans, whether it's the science, whether it's the clinical trial design, whether it's early thoughts on the regulatory strategy and the commercial opportunity, that's got to be pretty sound. And the team has got to be one that's the right team that can deliver on this. So I think the present day really requires a lot of rigor on the investment proposals.
So I think my panelists did a really good job of pointing out the key elements of the macro company formation. There is still a lot of capital out there. It's still at a historic high, even though down from the pandemic exuberance. And touched upon the important elements of the exit environment with a robust M&A that it feels like we've all been waiting for, and some green shoots on the IPO side. So I'm not going to rehash that any more than I have, other than perhaps to say that as the M&A and IPO activity continues, that perhaps will release a little bit of friction in those investment dollars going into new investments, sort of that flywheel. I do want to highlight that as a corporate investor that is unapologetically strategic, we sit in a slightly different position than my colleagues here from funds, where we're leveraging the strength of the J&J balance sheet in investing through JJDC. And what that affords us to do is to take a long-term strategic view and deploy dollars in areas that it will accelerate entrepreneurs and accelerate companies, but also allow us to participate in that acceleration through our expertise, through our dollars, through the capabilities that we can add. And so over the last 51 years, JJDC has been actively investing through the ups and the downs of these cycles. And, I think with the breadth of experience on the panel, we're probably somewhere in between our second and third kind of ebb and flow of the market in biotech. And then just to make the additional point that I think has been a thread through this part of the conversation is the de-risking piece. So Johnson & Johnson Innovation was established 11 years ago to play that role of helping to de-risk early stage science. And de-risking means a lot of things, a lot of different things, whether you're talking about incubating companies and supporting them through an ecosystem and providing mentorship like we do at J Labs, early stage partnerships and strategic collaborations to apply some research funding to de-risk and validate particular areas of science, and then ultimately collaborations and licenses to accelerate into the clinic and ultimately, to reach patients. So that's how we think about partnership and investment in the early stage. And that's not to say that we don't have a high bar. And I think we're all saying that in this environment, the business cases and the rationale has to be really, really compelling. But we're built to help accelerate early stage science and technology.
The one thing that I would add is the biotech market has always been cyclical, and it will always be cyclical, but good data and good science will always prevail.
Well, I want to dig in a little further on this because I've had many, many entrepreneurs come to me over the years and say, I don't get it. These guys are telling me that it's a risk-off environment. The average, I think I saw in your NVCA statistics, said it's 9.5 years from the time that they make an investment until the time that there's liquidity. Why in the heck do they care whether the weather is cloudy or sunny today? They should be making this investment for the long term. Why is that so important to have in a risk-off environment? And by the way, I don't deny that it's true. Everything you guys said is absolutely accurate. But maybe we can just dig a little deeper, anybody who's brave enough to do so.
Yeah, so I'll start and be very brief. I think the comments on the timeline horizon for investments is true, especially in biotech. We're slow, we take a lot of capital, and we're only spending it. Generally, we don't have revenues unless we get a nice partnership with our colleagues over in biopharma. So I think all of that is true. I think about the risk and the time horizon more as how do we navigate those 9 years, right? So if you're asking me today, I'm very excited to be investing today. Why? Because in a market like this, for an early stage investor, this is perfect. I can ride a 9-year time horizon because if I make an investment today and I fund a company for 2 to 3 years, I have to believe, VCs have to be optimists somewhere in there, that in 2 to 3 years, the company will have driven intrinsic value, but that the macro will have changed. And you ride those two pieces to the next stage. And so while it may take 9 years, I need to know that along the way, I can attract outside capital because we as Westlake can do a significant amount of work early in the stage of a company and provide significant amount of capital, but we need our follow-on brethren and our strategic friends and public markets to be there.
And let me just add to that. You need to attract capital at a reasonable price that doesn't wipe you out
Exactly.
for all the intrinsic value that you created during that period of time.
That's exactly why the macro, riding the intrinsic and the macro at the same time is particularly unique opportunity right now.
Yeah, and I was just, I wanted to say that the use of proceeds and the way that the companies propose those next steps of investment are actually really important. So yes, there may be a lot of risk at the point that you're starting, but if you're asking for a certain amount of money and you're very disciplined about that, and you've actually got really clear milestones in terms of how that is going to de-risk your program, at least to a degree, until the next sort of value inflection point, that's really important. So I think it's also about how you set up those even early plans, because even though a program's early, it doesn't mean that you can't make some significant strides in terms of de-risking the hypothesis that you're going after. And so I think real rigor around that is important.
I would just quickly add on to that it is, as they were saying, all about value creation and those I would say killer experiments. Really defining what is that value creation experiment that you want to do, and will that be a killer experiment or not? So really defining that and having a timeline to it, that really gives confidence to investors that, hey, yes, you've thought through it and that this indeed would be value creating when you get to that point. And it's always easy to say just, this experiment would be value creating. I think it's important to understand from like an investor's mind that one needs to show some like precedence on that, this company got bought or created this much value or raised at this valuation after they had like this amount of, or they had like this data. So really understanding what are those value creation points and knowing like what is the timeline to that and doing it in a budget that's feasible, I think is extremely important for venture capitalists to see.
So I'll just very briefly echo my earlier comments. As a corporate venture fund investing off the balance sheet, we are able to ride the highs and lows. Notwithstanding that, I think to Josh's question, we want to be able to pay attention to why and how to ride those waves. And I'll just share a quick personal anecdote. So I left the business development group at Genentech in 2009 and pivoted to a venture capital fund. And 2009 was perhaps the last nuclear winter. And, I think to Mira's comments, it's a fantastic opportunity to begin investing. But at that time, the stats were 60% of the biotech companies had less than 6 months of cash. And what was happening was VCs were looking at their portfolios, and they're doing that today now and have been since 2022, and all investing at different timeframes in their respective funds and making strategic decisions. So I think maybe just to make the quick point, it's important to pay attention to the cycle that you're in, because you might sit as a board member and an investor on a company board thinking that we're going to ride this out, we're going to bridge the company, but you might have a board member, an investor from another company that is looking at the context completely differently, and then you have misalignment. So I think that's another somewhat practical but sort of philosophical thing to think about as well.
And please take the money, when you actually have it. I mean, that's happened to some of our companies as well when they said no to money, but these cycles come and go, and once you say no to money, the wind is not with you at some point, and then problems start to come up.
If I can just make one other point, sorry to drone on here, but I think we've heard over this meeting as well about some really interesting initiatives. There's a CERM initiative and grant funding there. There's, J Labs and so forth. And there are other ways to get sort of non-dilutive financing as well, which is, especially in challenging times, it's really important for companies to be creative and think about how can we get access to capital maybe that's non-dilutive through, granting organizations and so forth.
It's a great point. And actually, I'm reminded in looking at one of my colleagues who organized a non-dilutive panel and session at this meeting last year, and I moderated a panel about all of those different alternative strategies. So it is a tale of two cities, and if you're not sitting on the data packages that VCs with money are ready to deploy, there are a number of alternative strategies to get some initial funding.
Well, that's great. I do want to dig in further on funding strategies and the like, but I'm going to leave this the part we've just talked about to sort of summarize it as, it's not you, the entrepreneur. It's not me, the venture capitalist, but it's the macro environment. And you have to pay attention to the macro environment, that you're in, as much as it's unfair to do so. That has nothing to do with it. At the end of the day, if it's that type of environment, you have to raise your game, which to me is a good segue into how startups do attract funding. What is it that makes the funded and separates the funded from the unfunded? I adopted this expression many years ago that basically startups need 9 lives because they're going to burn through 8 of them. Okay, every one of them, and I don't care how the stories are written afterwards. There's always moments when you really call yourself into question. And to Sahil's point about taking the money, that provides you that life preserver when you most need it on that. So let me transition that into a question to the panel as to how and what do you see as superpowers, the things that differentiate startups and make them special and therefore more likely than not to get funded?
So I think it's 3 things. I think it's people, and people. And I'll tell you why. For a couple of reasons. One, we're not for lack of innovation. I mean, this is an incredibly special time to be in biotech. It will be for a while. And there's innovation happening in every modality and every indication. And so that's not rate limiting. What is really rate limiting are people who know how to take that innovation and make a medicine, build a business, and build teams. And so I've rarely seen companies fall apart because the science failed, because those companies are led by teams that know how to pivot, whether it's pivoting where they point the science, whether it's taking all of that science out of the company and putting something in. But something I have seen, and what every single time a company fails, it's the people. And I've seen incredibly promising science run into the ground by poor decision making, whether that's execution or strategic or simply leadership. And so actually at Westlake, we call our model people first, because whenever we can, we start with the people and we try to match them with the right science in terms of their experience, their expertise. And so I almost never see an investment come that has all the pieces. But if I can find great science and I've got at least one person to start pulling that together, especially as an early stage investor, it's actually that bringing together where the magic happens. And so that's when you find something. It's never there in the first meeting, but somehow you can kind of pull pieces together to make it come together.
100%. I would say the one word that actually comes to my mind in terms of like this super abilities, I would say, is adaptability. And today, I think Biogen CEO mentioned that we are not in a business of Twinkies, right? And that's so true. That it's not that that you have one thing and you're just taking it along. You need to know exactly when to pivot, and how the macros are riding. What is the data that's coming across. Biotech is extremely innovative, and every 6 months things change and new data comes out. There's a new way of thinking. So it's extremely important to change. And one example that comes to my mind is, at least in cell therapy, is the fact that everybody wanted to go after oncology when cell therapy started. Of course, like CAR Ts, and it was curing cancer, basically heme cancers at least. But people, and there were a bunch of companies that started on those bases. But now you see a lot more companies adapting to it and going into autoimmune disorders. So, and I would say that the first few companies that actually did that really recognized that New England Journal of Medicine paper that came out that really showed that yes, you can actually cure or at least have responses in autoimmunity with the CAR Ts. The first 5 companies are the ones that are probably thriving right now. But again, the rest of the companies that took a lot more time and did not adapt are struggling right now.
Sure. We're shuffling the deck here. So wearing an investor hat, it's hard to argue anything but what Mira said. People, 100%. In the last panel, the funded panel, one of the CEOs summarized it as great people, great science. And so maybe I'll just pick up on the science part and frame it up as patient first. So J&J is guided by our credo. It's a living 80-year commitment that we have to our patients, to caregivers, to families, to our communities, and then to our shareholders. And so with that as our guide, patients first, we're absolutely looking for breakthrough transformational science. And when we evaluate opportunities, whether they're partnership opportunities or investment opportunities, it is about what is going to change the game for patients. Not a little bit, but what's going to be transformational given the existing regimens. So I think it is about great science and how care is going to be transformed.
And just to make a couple of other points, I do think, again, not to double and triple down, I guess I am, but I do think the people absolutely, but the nuance or the addition for me is the culture that those people build, because every biotech has a certain culture to it, and it's about decision makings. It's about how people collaborate. And having been on the operational side for many years, I personally enjoy the environment where people don't stay in their silos. They don't stay in their lanes. They go across. People can have good ideas from other areas. And that's why I love small biotech, is that you're a scrappy group of people that have the same mission. You want the company to be successful. You want to help patients, and you don't stay in your lanes. And I think the leadership that allows people to go beyond their lanes is really critical. And I think on another note, there's this fine line in biotech between having deep commitment in your programs and yet maybe not having religion on it. Because I've also seen companies where the signs are pointing that your lead drug, your sixth or seventh life, is not going to be a successful one, and you have to make some tough decisions and say, we're not going to continue to waste our resources, money and coin on, or people and coin on this, and we're going to pivot. And so I think it's also about, working together and figure out, when do you remain committed to something and when do you pivot to something else? And that's really critical, because that's where the people come in over the science in a way, because you have to be willing to make those tough decisions.
Yeah, that's great. I appreciate all your comments. And just the takeaways for me from this is people, okay, for sure, with great science, okay? You got to have both. As Mark said in the prior panel, you got to have both to really have a winner and to create that sort of unfair competitive advantage and the like. One thing I would like to add, and I'd love to get your guys' comments on this too, is my experience in Silicon Valley with great entrepreneurs is that they tend to share the trait that they're really good strategic thinkers. But the truly great ones are great execution animals. They can actually do what they said they would do. Sounds darn simple, but it is the distinguishing characteristic that I've seen in entrepreneur after entrepreneur. So, for example, the conventional wisdom is Steve Jobs was a strategic genius. Well, yes, he was. But I don't know how many of you know that the iPad was a commercial product 12 years before Apple introduced it and before he designed it there. And in fact, he had a company where he created the iPad at that time. And it was a complete failure. Why? Because it was too heavy. Because it had sharp edges on it. He beveled the edges. He made it lighter because technology had advanced. And boom, you have a success. But that's execution on the smallest details. So I don't know if you guys agree with that or not, but that's my observation of great entrepreneurs.
I would say the best CEOs I've ever worked with are animals. They just run through walls. They're also very self-aware. So how do they execute? they know what they're good at, they know where they struggle, and they hire people who are better than them to kind of get through those. And they know their job is to run and get everybody to run with them.
Right.
They also are paranoid, and they have a plan B and a C and a D because they believe the lead program is going to fail, and they're already thinking about what they're going to do next.
The 8 lives.
That's right.
Well, I was just going to give a vignette that I think applies, and I agree with you completely. When I first joined Genentech as a young medical director, I wrote a phase 3 protocol, and it went through the chain and got signed off. And then the head of oncology, Gwen Fife, at that point, walked into my office, dropped the protocol, and said, "Great job, Jacob. Now your work really begins." So the point was, you can have a great strategy, you can write a great experiment and a great clinical trial, but you got to execute on it. You got to find the right patients. You got to make sure the investigators adhere to the protocol. You got to analyze it right and all that kind of stuff. So it's hand in glove. It's strategy and it's execution. You got to have both.
I would say that the best entrepreneurs that I have met, they have the big goal in their mind always, but they always break down their goals. And then they execute based on that. So A goal, A1, A2, A3, and just look at what is A1, get to that, and then decide, do they want to go forward or not?
Maybe just a last comment. Hard to add much that hasn't already been said, but I do think that when you see companies at the earliest of stages where it's setting the strategic vision and then starting to build the plan, some of the best entrepreneurs and CEOs that I've worked with know what they don't know, and either, as has been said before, hire those that are better than them, or actually raise their hand and say, "I think it's time for a transition," and bring someone in at the right stage of the company. And sometimes that's about strategy and execution. Sometimes it's about scientific founder now moving into, a clinical or, even commercial stage. Great.
Well, we spent the last few minutes talking about the ideal startup for funding. Now let's move into, I want to move into a little bit more of the pragmatic side of it. Let's say there may be a random entrepreneur here in this audience saying to themselves, "You know what? I'm not going to check all those boxes. And not only that, but the funding environment isn't great right now. But, if you give me a year, I could probably get by. I could get through. The funding environment will be better next year, I'll assume." What are the key things that an entrepreneur who is, strapped for resources need to do during this, what I'll call semi-hibernation period that's going on?
Well, I would say a couple things. Cash, you can take a little bit of cash and do quite a bit on it. I have a friend who's been showing me a version of a business plan for 3 years. Friend from graduate school. And every year I kind of look at it and say, kind of, not really, but kind of. And then they take the advice and they go back and they do a few more experiments, or they make a different molecule and they come back. And they recently came back. They're burning very little cash and they're just kind of iterating, and they did something pretty interesting. I said, I think you're ready. And so they navigated the last 3 years incredibly successfully by being two people who spent, I don't know how many hours a week, probably all of their time asleep and awake, thinking about this problem. And they had an unwavering belief that they were doing something interesting and just needed to get it to the right, pointed in the right place and the right data set. And they did it. And I can't believe they did it. They did it by grabbing little bits of dollars here, doing a little, paid for project there, and ultimately got themselves to where they needed to be. So I think they're going to do something pretty interesting, but it took a lot of perseverance for them.
That's a great example. Others?
Yeah, I think we've alluded to it already, but I do think that entrepreneurs really need to prioritize these days. So again, to your point, if you got a little bit of cash and you really need to stretch that and make sure that you're spending it on those things that are going to create the most value. And so I think that prioritization is really critical. I also think that to the degree that you can, keep being out there and telling your story, because I think there is this aspect of meeting with enough people, and someone along the way, your idea may resonate with them. And so I do think you have to be out there telling your story, and it can be about sort of that right match where you're going to find that person that's going to want to invest and is passionate about what you're doing as well. So just a couple of thoughts.
I'll build on both of them. So there's a lot of dichotomies that we're elucidating here. One is prioritization and focus, and yet have a plan A, B, and C. And so that's a challenge. I think in terms of the build on your prioritization point, knowing what the value inflection points are, and conversely, what the go, no-go decisions are when, either to pull the plug or to go to plan B. And that's, perhaps implicit in the prioritization piece, but I just wanted to bear it out because it's actually one of the things that we use to evaluate partnership opportunities. As we go in and think about funding, what are the go, no-go decisions so that we know that we're, continuing on the right path. The second piece, as it relates to going out and telling your story, is share your story and ask for feedback, because the gem could look different to different people and different entities, and having a sense of the value in one entity's eyes and where it exists. Because then as you iterate and you go through where, what you're able to unlock, the opportunities, might be to send you in one direction versus the other, as it relates to partnership and investment.
I would say go and get non-dilutive funding. And I know it's easier said than done, but I think it's important for cash-strapped companies to really explore that option. And there are quite a few areas or institutions that are giving those non-dilutive funding, including the NIH. So go and get that, and then persevere. And within the macro cycles, if you are in that time frame and you're persevering enough, you're in front of many VCs. Your lightning would strike, and your day will come, and then you would get that funding, and you'll make it. But in the scenario that you don't get any, probably it's time for you to move on as well, because I think. I felt over a period of time that that's sometimes people are in love with what they do and they think that it's the best thing ever, and there cannot be any faults in it. So I think it's important knowing when to stop.
Well, that's great. Well, those are great answers, and I want to just again kind of summarize what's going on in my mind as I listen to this. 2 words stuck out. One is prioritization, and the second is 2 words. It's inflection point. Often biotech entrepreneurs sit there and shake their head when they see, like when we went through the apps being done, these small engineering efforts all of a sudden result in these multi-billion-dollar valuations. And engineering tends to be a very deliberative, determinative field. Whereas when you're dealing with biology, of course, you have serendipity, you have other types of things working out there. But what it lends itself to is inflection points. I mean, you can run this experiment and all of a sudden gain an insight that no one had before and create true differentiation, from others. So to me, inflection points, which can be to your point, very low cost, to make that happen. The second is prioritization. And I would suggest to you that prioritization is a daily checklist. It's a daily line drawing. What's important today? And most of the great entrepreneurs that I know wake up asking themselves that. What's the most important things I can do today to make that happen? Well, I want to pivot a little bit because to a completely different side of the equation, which is people often ask me, I'm sure they ask you as well, how did you get involved in venture? What is the path to becoming a venture capitalist? And since we have this great panel here today, I'm going to ask them that question.
Well, I don't think it's planned. Mine was a happy accident, right? I was at Genentech. I was seeing all these little biotechs pop up around me, and I was like, well, that looks fun, right? That looks like innovative. It looks exciting. The most high potential medicines are coming out of these little companies. I'm going to a little company. So I started interviewing, and I met people. Mm-hmm. And in the process of that, two of them happened to be portfolio companies of 5AM Ventures. And I was noodling on if I should take either one of the roles. And they said, go talk to our investor. And I accidentally joined the firm instead of joining the companies, right? And I was at 5AM for almost 7 years. Now, it wasn't as random as it seemed. What happened was I built relationships with the people at those companies over the course of many months. And as I was trying to figure out what I was going to do, and those people called 5AM and said, hey, there's somebody interesting to look at. And so I think venture is a very, in many ways, risk averse on the people front. They want to know that, a person has been somewhat vetted. And so the one thing we do a lot of is we trust people who are recommended to us by people we trust. And so becoming one of those people that builds a network and where you demonstrate what you can do to people who are built into those networks, you sort of accidentally wind up there, which is what happened with me.
I just want to add one thing to that. I call that concept, the last one you talked about, triangulation. 3 independent points of contact. When you're going into a venture capitalist, you walk in the front door with your deck, okay? But if there are a couple other points of contact that are completely independent of that and say, hey, I hear you're seeing Sally today. Sally is the most amazing person. I just hope, and if you got any questions, give me a call. And as a trusted source, it is unbelievable how it separates you from the pack, because I don't know about you guys, but when I was in venture, loosely speaking, and I'm talking about random emails and everything else, you get over 1,000 inquiries a year in terms of people who want to be funded. And you're going to do less than what's on this hand. So, yeah, go ahead.
I would say to get a job, you should know the job. So basically, understand what exactly do venture capitalists do. Talk to them. Get fellowships. There are a lot of funds that have fellowships as well. Even Vertex, which is 8C, has a fellowship program. Go and join it and understand exactly what we do. And once you know exactly what is being done there, talk to people around. Again, lightning would strike someday, and you might end up with an offer. I would also say that it's a twist on what people generally say. It's jack of all trades, master of one. I would say that because you should know everything that's happening in the biotech field. Just the basics of it. What companies are doing well, what companies are not doing well, what's happening around. But you should have that one thing, maybe it's immunology, gene therapy, cell therapy, whatever, that you should be a total expert in, that you should be able to carry conversations with venture capitalists, you should be able to carry conversations with your interviewer to that level of deepness that they actually acknowledge, hey, this is what I remember from this person. They're like, I saw this company 5 days ago, I'll probably want to get your thoughts on it because you seem to be the expert in it. So I would say it again, jack of all trades, master of one.
I actually want to build on that because I get asked this question a lot. And my answer is something that sounds like have a point of view, have a thesis about something. So certainly know the macro environment, know what the role looks like, but bring into the door a thesis about something. And that usually means pattern recognition. I mean, we talk about pattern recognition all the time. And so for me, it was about how technologies converge in markets and what new opportunities are enabled. So regardless of whatever it is, come in with a thesis and demonstrate the analytical capabilities of thinking about a challenge in a different way, thinking about an opportunity in a different way?
So my perspective on entering venture, I came into venture sort of at the back end, I think, of my career, where I'd had an academic career and I had an industry career, and sort of built a level of expertise getting drug approved, filing INDs and so forth. And so that was a good opportunity for me to join venture, because I felt like I was bringing a certain skill set along to help critically evaluate. But I don't think that's the only way to get into venture. I mean, you mentioned it as well. You can do fellowship programs, you can do your internships, that type of thing, and start as an analyst, as an associate, that type of thing, and principal, and then make your way up through. So you could sort of enter at different points. But I do think that there's a few themes when it comes to venture. One is certainly you need to bring critical thinking and expertise. And I think the expertise gets broader and broader as you see more things, but you also have to be able to sort of think on your feet, because you're going to get these pitches that occur. So 45 minutes or an hour, you're going to see, and you're going to have to make a pretty rapid opinion on whether or not there's something there or not that you want to further pursue. So I think that's another aspect. The other thing about venture, I believe, is that it's a team sport. So you don't really do a deal by yourself. You form a deal team, you do diligence, with the rest of with some of your teammates. You can bring in KOLs to help you do diligence and all that. So I think you have to be very collaborative, I believe, as well on the venture side. So that's something, that is one of the keys to success in life, I guess, is that you just have to be collaborative in the work that you do. And that's absolutely the case for venture as well.
That's great. Well, at this point, I want to open it up for any questions that folks have. I have one last question for our panel, but I want you guys to participate as well. Way back there.
As far as de-risking goes, besides de-risking the technology, what do you look for in de-risking the business model?
So one thing, I'll speak for Westlake, one thing we don't innovate on is business model. And so we do biotherapeutics. We fund generally preclinically, but we will fund an in-licensed clinical stage asset. And we're looking for on $30 to $50 million, can we get to for the early stage stuff in IND or a phase 1? And for some of the later stage assets, what's the next clinical point? We actually what we don't fund to, interestingly, which is a little bit different, are early stage go-no-go decisions preclinically. To go back to the previous point, if we know that there's a great person or the start of a great team, we're willing to back them for the full amount, knowing that they're probably going to have to cycle through 5 or 6 different ideas or 5 or 6 different iterations of whatever they're trying to do to get to where they're going. And so we actually don't tranche or we don't bin on early stage. But what we think about is what's the IND and what's the first clinical data card you're going to turn over to validate a molecule on those kinds of financings.
Yeah. I think de-risking can also vary depending on the company and the therapeutic hypothesis. So if it's a cell therapy company, for example, we know manufacturing is a really big issue. So there could be de-risking around your manufacturing approach. If you're more of a clinical stage, then de-risking around some of the regulatory aspects, or your clinical trial design, as it were, and a readout that's going to be, a value inflection. And I do think this other point about the team is really critical, because if you've got a cancer company and the chief medical officer or the chief development officer is a neurologist, you may not feel quite as good about that. So I think you got to de-risk the team as well to make sure that this is the team that's going to be able to come up with the right strategy and be able to, deliver as well.
Great. Well, we only got about a minute left, so I'm going to open up to any last comments and any predictions about the future. Don't worry, the camera's not recording, so it doesn't.
I'm going to combine a response to the last question with I don't love predictions, but maybe a area where there's a robust amount of activity. So Mira brought up a really good point. When you're investing in biotherapeutics, there's a pretty solid business model of how to get therapies to market, how to develop them, and discover them. We recently entered into a collaboration with Big Hat Therapeutics, which is using AI to develop and design novel antibody therapeutics. And I think you could look at that as a de-risking of the business model associated with discovery of novel antibodies. And so as we think about AI and generative AI as a disruptor to the traditional biofarm model, we're heavily landscaping and looking at that space.
Others?
I'll just say, as someone who moved from the Bay Area to LA a couple years ago and attended LA Best maybe 3 years ago for the first time, it's incredible to see both how the ecosystem has been growing, and that's reflective in just the number of and the quality of people who come to LA Best year after year, and it's been great to see the progress.
That's great. Sahil?
I'll just say to entrepreneurs, just persevere and your day will come.
Jacob?
Yeah, and this is just stuck in my mind, but this idea of pivoting, I think you brought it up earlier, but your drug may actually not be the right fit for your first indication. You may have to pivot. And so you think about cell therapy going into autoimmune, you think about ibrutinib becoming a blockbuster drug where it failed in 2 other companies. It's just that openness to pivoting, coming up with new ideas and keeping on reinventing and reevaluating.
Terrific. Well, we're going to sum it up then by simply thanking our panelists and saying that basically, a lot of these panels end up in platitudes about venture capital and investing. I just really want to thank this panel for the real answers to these real questions. And I hope it was very helpful to all of you. So thank you for doing this.